that a lot of investment managers will increase their exposure to gold, bearing in mind stocks have done so much better and it's maybe time for a catch-up in gold. Where do I think it's going to go? We'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch up with the level of government debt. The amount the government debt has been increasing since 1971. Just playing catch up would take us into the high 5,000s. But of course, it would have to go an awful lot higher if they wanted to have any form of backing of the currency with gold. There's no suggestion that they're thinking of that at the moment.
The precious metal gold has shown remarkable patterns in its price movements over the past few decades, with experts now projecting significant potential for future growth. Clive Thompson notes that from 2010 to 2020, gold showed modest growth while the stock market tripled, contrasting with the previous decade, 2000 to 2010, when gold surged 300% amid economic uncertainty and a declining stock market. 2010 serves as an interesting reference point in gold's recent history. During this period, the precious metal demonstrated steady appreciation, climbing from $1,096 per ounce to $1,405 per ounce by year's end. This upward trajectory reflected persistent economic uncertainty and inflation concerns after the global financial crisis. A decade later, 2020 emerged as a pivotal year for gold, largely due to the unprecedented impact of the COVID-19 pandemic on global markets. Gold reached new heights starting the year at $1,589 per ounce, touching $2,073 in August before settling at $1,896 by year-end. This dramatic price movement highlighted gold's enduring role as a safe haven asset during times of global crisis. Looking ahead, market analysts present optimistic forecasts for gold's future. Thompson projects that gold could reach between $3,000 and $7,000 by 2026, with a likely target in the high $5,000. He attributes this potential surge to gold catching up with the substantial increase in government debt since 1971. Supporting this bullish outlook, Florian Grumes anticipates significant appreciation over the next 2 to 3 years, suggesting a quick rise to $2,500 per ounce and potential further advances to $3,500 and $5,000. He emphasizes that this price formation has been building for 12 years and describes the upside potential as phenomenal. Some forecasts extend even further, suggesting gold could reach $7,000 per ounce by 2030. These projections are based on several key factors, including low real interest rates, rising inflation, and demographic shifts expected to drive increased demand for gold as a secure asset. Before watching this video, subscribe to our channel, hit the bell icon to never miss an update, and share it with others.
We had roughly 10 years from about 2010 or 11 when gold did nothing and the stock market went up maybe 3 times. That was in complete contrast to the decade before that, when gold went up 3 times, something like 300%, when the stock market went negative. So the S&P 500 went down over a decade, and gold went up a lot. That was from 2000-ish until from when the stock market crashed in 2000, the dot-com bubble burst, through to about 2010 or 11. And then we had a period when the stock market was the star performer, and still is, by the way. So people have looked at the gold price that they had, and many of them bought it at the end of the bull market in 2010, and they're saying, I've had it for a decade, it's done nothing. It's just a little bit above my purchase price, but look what I would have made in stocks. So they're selling out of it. I think there's a huge amount of nervousness about the gold price. That will dissipate over time, and eventually when the bubble, I'm going to say it's a bubble, but let's say the huge rise we're seeing in the top 10 stocks in America, when it comes to a halt, as it surely must do at some point, and I'm not a bear here, I'm just saying it's got a little bit ahead of itself, but when that stops and pauses for a reasonable length of time, people are going to be looking around for other things which are rising, and of course gold could be one of those things that they move into. As to my price projection, we're about $2,500 now. It would be quite a thrust to get to 3,000, which was, for many, the year-end projection. I think it's still possible. We've got a few weeks to go, and it could move very, very fast on very little news. But I think we will probably move a little bit higher before the end of the year. But when we go into the new year, people and investment managers are going to be looking for the story of the year. As they go into the 31st of December, they're going to want to be holding those hot assets, the NVIDIAs of this world, the things which have gone through the roof, because that's what their clients will be saying. Do you hold any NVIDIA? Do you hold any Bitcoin? Those sort of questions, because they're hot assets. I don't think they'll be getting that many questions about gold, but once they pass the 31st of December, it'd be time for a little bit of portfolio rejigging. And I think that a lot of investment managers will increase their exposure to gold, bearing in mind stocks have done so much better, and it's maybe time for a catch-up in gold. Where do I think it's going to go? I think we'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch-up with the level of government debt. The amount the government debt has been increasing since 1971. So just playing catch-up would take us into the high 5,000s. But of course, it would have to go an awful lot higher if they wanted to have any form of backing of the currency with gold. There's no suggestion that they're thinking of that at the moment. But if we get into a currency crisis and there's a generalized level of distrust for some reason, and that's not looking likely yet, but it could happen for some unforeseen reason, they might have to back the currency by something. And if they were to back it, there's no way they're backing it at $5,000 an ounce. It's going to be $100,000 an ounce or $70,000 an ounce or $150,000 an ounce. It would take that sort of level of gold price to cover the amount of national debt that they've got.
Now, when it comes to the price of gold, you mentioned how maybe $5,000 would be more fair value compared to how much debt. Can you maybe run us through the numbers? How do you get to that $5,000 level right now?
So what I did, I took the level of debt in 1971 and the gold price in 1971, which was effectively $35 going on $40. I haven't got the figures in front of me, but I projected that forward to the present level of debt, which is 30 trillion. And if the gold price has kept pace with it, the gold price should be in the 5,000 and the high 5,000s already. Simple as that.
Thompson suggests we're entering a new inflationary era, potentially beginning late next year. His analysis points to a critical mechanism. Governments may increasingly rely on central banks to purchase their bonds as they face challenges borrowing at sustainable rates. This process, essentially involving money creation, could further fuel inflationary pressures. Recent data suggests the world is experiencing an inflationary surge unprecedented in recent decades. In the United States, inflation reached 7% year-on-year in December, marking the highest increase since 1982. The Eurozone recorded a historic 5.1% inflation rate in January, the highest since 1983. Harmonized statistics began in 1997. This trend extends to Latin America, where countries previously maintained moderate inflation rates have significantly increased, with Brazil reaching 10% and Mexico and Chile hitting 7%. While some experts anticipate inflation moderation as supply-related pressures ease, significant uncertainty remains regarding central bank intervention. The timing of these interventions presents a crucial challenge for central bankers. They face a delicate balancing act. Premature action could prove costly to economic growth, while delayed response might allow inflation to become entrenched, potentially leading to more severe consequences. Let's get back to the interview.
I think it means we move into a much more inflationary world down the line. And I'm guessing that's going to start probably late next year when the government will start seeing that they have difficulty borrowing at reasonable rates. So I don't know what a reasonable rate would be, but I got a feeling that somewhere between 5 and 5.5 starts to become tough for the government to manage. And they're going to say to the central bank, would you like to buy some of our bonds, please? And the central bank, whether it does it willingly or not, will do so. And that will be printing money to buy the government bonds, which is inflationary. But I mean, from another perspective, we mustn't forget the fact that the government is borrowing money anyway in itself is also inflationary. Why is that? Because what's happening as the government borrows money, the government gets poorer and everybody else gets richer because the government's spending that money. So the government's deeper and deeper into debt and everybody else has got that money. Of course, it's not everybody else. It's the people at the top of the food chain, the wealth creators of this world who are getting richer. It's not actually pushing up the prices of most day-to-day items, but for things which are in short supply, and that includes labor, housing, gold, equities, silver, Bitcoin, land, relics, works of art, those sorts of things which are in limited supply and are desired are likely to rise in price quite fast. Things which are made by robots, for the people at large, they're mostly mass-produced. They're made by robots, so the labor element which goes into that is relatively small. So There will be inflation in those things, but it won't be as high as the inflation in the kind of rare and more desirable goods. 2 cuts in interest rates, the short-term rate, the Fed funds rate, they've cut rates by 0.75%. But since the day they made their first cut, the yield on 10-year government bonds has risen by 0.75%. So at the one end, we've had a cut at 0.75 at the short end, and at the longer end, the 10-year end, which is not totally the long end, but it's sort of middle of the range end, we've had a rise of 0.75. So what's happening, I think the bond vigilantes are out there, and they're saying, you know what, cutting rates isn't going to stop inflation. It's only going to encourage inflation down the line. And I want a higher yield to compensate me for the probability that interest rates will be raised next year or the year after. So I'm not such a bull. I think whilst I think interest rates are going lower in the short run, I think that's a temporary phenomenon. And I think we'll probably by the middle of next year, I'll be talking about rate rises.
Gold and silver are poised to play a crucial role in the evolving economic landscape as inflationary pressures continue to rise. With the potential for significant monetary expansion and increasing government debt, these precious metals may become increasingly attractive to investors seeking a hedge against the erosion of currency value. As inflation accelerates, the value of gold and silver could rise in response to the growing demand for tangible assets. Do you think gold and silver will continue to rise as inflation accelerates? Let us know your thoughts in the comments below. And don't forget to like, subscribe, and turn on notifications for more updates. Thanks for watching.